Markets are reacting to the Fed, Jay Powell, chair of the Federal Reserve's statements yesterday, and starting to anticipate a bit of a recession. So let's take a look at what's going on here in the markets. Markets closed down, the Dow down 2.25%, S&P down 2.48%, NASDAQ down 3.23%. And if you watched the video yesterday, day before, it's kind of like what I was talking about was the markets have priced in inflation risk. They've priced in interest rate risk. What they have not priced in and cannot account for yet is recession because it's just not quantifiable. The Fed thinks that they can avoid a recession. Markets do not believe that, but the markets at the same time do not believe the Fed will hold steadfast in the face of a recession. They still think the Fed is going to back up, start reducing rates sometime in 2023. The Fed said, no dice, we are not going to reduce rates in 2023. In fact, we're going to get them up to 5.25 to 5.5, which is still a nice little spread from where we are now. So this is all market reactions to that and contemplating with retail sales coming in a little bit soft today, that there is a potential for recession going into next year. And that's the one conversation. So there is a narrative in the space out there that if everybody thinks something's going to happen, then it's likely not going to happen. And they're going to be a contrarian investor and take the other side of that equation. Well, recessions and inflation doesn't really work like that. In fact, it can kind of be just the opposite. If everybody expects inflation, they're going to start acting like there's inflation, which is going to create recession. And if everybody thinks there's recession and they start acting like recession, then that can exacerbate or create more of a broad spread recession. So it's not like the narrative, and even in Wall Street stocks, crypto, Bitcoin, whatever, you hear the narrative from people that say, if everybody expects Bitcoin to go to 10,000, then it'll never get to 10,000. Well, we heard that at 20, and what happened? Now we're down to 15.5 for a low. And what often happens is when a lot of people think one thing is going to happen, it goes much further than what they expect. So if you think it's going to 20, and a lot of people think it's going to 20, it'll go to 15. And if everybody thinks it's going to 10, which there's a lot of people that are calling for $10,000 Bitcoin and think, there's a chance that it could go to 10, then the most likelihood is in a bear market like we're in right now, that it goes to 5. So that's kind of what happens there. As far as a recession, if everybody expects a recession, is calling for a recession, it doesn't really work like that. You can't short a recession, you can't long a recession, you can't leverage a trade on a recession. Obviously, you can trade stocks into it or whatever, but a recession is what it is. It's slowing growth in the economy due to, could be a number of factors. Right now, it's because of inflation. Inflation is reducing consumers' ability to spend because it's reducing their purchasing power. So that creates a slowdown in the economy. If people spend less, then manufacturers produce less, and that generates a slowdown. Inflation exacerbates that. And the higher the inflation, the more damage that does. And then when the Fed tightens into that to try to tighten financial conditions to reduce inflation, then that further damages the consumer's ability to spend because they want people to feel less wealthy. They want the cost of that spending to go up in terms of credit, things like that. They want to reduce borrowing, reduce leverage, those types of things, tighten financial conditions so that inflation will fall a little bit. So the narrative of if everybody expects recession, then it's probably not going to happen. That's just not even a thing. It just doesn't work that way. And it doesn't work that way in markets either. Like I said, they can go higher than you think, they can go lower than you think, and that's usually what happens. And that's kind of where we're at today. On other news, house flippers are losing money across the country with real estate prices adjusting rapidly. There's a lot of distress out there in commercial and residential real estate with mortgages and loans, repricing, debt coming due, and people thinking that rates were going to stay low and the market was going to continue to increase. So the real estate market, housing, commercial is at an inflection point right now, and a lot of crazy things going on out there. And then in other news, CZ of Binance was on CNBC today, countering Kevin O'Leary's remarks about Binance, discussing Binance's reserves, discussing possible audits and financial audits and things like that. So that was an interesting interview. If you didn't get a chance to watch it, you should check it out. It's going to be all over YouTube with a lot of people playing those sound bites. So I won't play them with you here, but long story short, the concerns remain there. They are not providing any real audited financial statements or bank accounts. He's just saying, we're fine, we've got the money. Same thing we heard from Sam Bankman-Fried. So until you prove it and show verification of your accounts and true financial audited statements, I mean, people just aren't going to believe you. And the excuse is, well, we can't get anybody to audit our stuff. And it's because of the liability and the fact that they don't have the proper documents. And he's just saying that because it's easy to say versus actually having it done, kind of like Tether. Tether's been saying for years that they're going to produce audits. They won't and they can't because that will show what's really going on behind the scenes. So the question is, how long can that continue before something happens and the next shoe drops? So what do you do in the meantime? You just if you're going to trade USDT, if you're going to have funds and assets on Binance, then you have to protect yourself and you have to be ready to lose everything if and when something goes down. And I'm not saying it will. I'm not saying it has to. I'm just saying that potential is there, and that the story coming out of Binance and CZ is the exact same story that came out of SAM and FTX. So you got to be careful and cautious there. So we're just in that mode right now. Here's Bitcoin down on the day, just like the markets, probably about the same amount. Markets were down about 2%, Bitcoin down 3%. So Bitcoin's kind of falling in line with the markets here. Bitcoin was up yesterday with the markets. Bitcoin and Ethereum basically, 4%. Ethereum is kind of tracking along almost the exact same price action. We've been talking about this in terms of the algorithmic trading that goes on, keeping price action similar across a lot of assets. Some of the altcoins have not kept pace with Bitcoin and Ethereum. They're kind of doing their own dance across the altcoin space, but take that for what it is. And something to look at that we talked about the other day was December. So last December, here is where we were, December 15th, 16th last year. Bitcoin dropped during that 2-day span about 8%, and then went on to rally. I think it was 15% we looked at yesterday. Let's check it out here. That was a total of, about 15%. So it dropped and then rallied off of that and then continued the decline down. Is that what we're going to see this year? Seems like the market is setting up for that same type of thing. Like I said on the last couple of videos, I expected downward price action to the end of the week, and then possibly a rally going into Christmas next week, as the markets will be open a full week. So interesting with Christmas and New Year's being on the weekend this year. I don't think we're going to see any down days on the market unless they close maybe on Monday or something after Christmas and after New Year. So we'll see how that plays out. Here's the Dow down a little bit on the day, the NASDAQ, S&P, and then of course the VIX making a little bounce there, the dollar making a little bit of a bounce, and the 10-year continuing its decline as investors are running into safety, and the bond market questions the Fed's ability to avoid a recession. But again, this is all temporary stuff. Let's go look at the S&P and let's take a look at what happened last year. So this is what we talked about the other day. S&P kind of did the same thing. This was the time of year, bounced up about 2-3% into the 16th of December, then dropped down. Let's see what that decline was. That was about a 4% decline starting around the 16th of December. Today's the 15th, and then bounced into the end of the year, 6.5%. And that was pretty much consistent across all the major indexes, and then continued down from there. Right now, the market is down. Last few days, it's been down overall 5%, so a little bit deeper than last year. So probably another down day tomorrow, and then next week we could start looking for that Santa Claus rally as we move into Christmas. Let's take a look at 2018. Here's the interesting thing. Oh, not 2018 on the S&P, but 2018 on Bitcoin, and I marked it out right. It's here, right here. So here's 2018 on Bitcoin that we looked at the other day. Same time frame right here. Where Bitcoin kind of bottomed out on the 15th, 16th, and then went on a nice little 30% rally. But that was the market bottom of that bear market cycle. That was a 35% rally, and then went on to set a double bottom, and then moved on from there. But again, this was a macro bull market. It was a bear market for Bitcoin within a macro bull market, global macro bull market environment. And then, of course, we know what happened after that. So this scenario, I don't think is very likely. There's no conditions precedent for any kind of a market reversal right now. What's most likely in the cards is a revisit to the lows, maybe a little bounce with the markets for Santa Claus rally, and then a revisit of these lows to see if they're going to hold, and then put in a longer consolidation until we get into next year and start to understand what recession looks like and what the economy is really going to look like and jobs and things like that, for all markets to kind of start putting in a bottom for this macro cycle right here, or start reaching for new lows. So I don't think we're going to find any of the answers to those questions until we get into next year, in terms of whether this is a macro bottom here for the next bull run, and we can kind of put in a base. Bitcoin can put in a base, markets can put in a base in these areas, ahead of the next cycle. The Dow is still up quite a bit, has a little bit of room to come down, as where the NASDAQ, you could make a case that NASDAQ could come in here and start carving out a bottom if recessionary concerns have been alleviated a little bit. And some analysts are saying we won't see new highs for 10 years. So, markets can range for quite a while, and let's see what that looks like. So let's go back to even 2017, 2018. This is on the S&P here, 2017, 2018, kind of tightening cycle for the Fed. That was January to October. That was only a few months there, but 2009 is the big one. When you look at this whole cycle here, from the time it started until new all-time highs were achieved, that was an overall spread of probably, how long was that? That was about 1,300 days. Let's look at this in weeks here. Let's go look at this one more time in terms of weeks. So from the top in 2007 until the market revisited those areas, it was about 296 weeks. So that is a good long time. It was several years, basically from 2007 until 2013. It took 6 years basically for markets to revisit all-time highs in the S&P. Then if you look at NASDAQ, after the dot-com era, it was quite a while before the NASDAQ got back up to those levels. I mean, that was basically 2000 until 2015. So it took 15 years for the NASDAQ to get back to all-time highs after that crash. S&P back in 2000 wasn't quite that long. It was basically 7 years. And then the 2009, which is interesting, basically another 7 years, 6 years from that time frame. So from this area here to this area here. And then it was just off to the races from that point on because of QE and low interest rates. So interesting stuff to look at in terms of, time frames it takes for markets to recover after all-time highs, or previous markets that go into deep bear markets and then getting back to all-time highs. There's a lot more capital in the market, a lot more liquidity that's been created and put into the markets, and a lot more capital on the sidelines that go into the market. So we may not experience quite that long of a time frame to get back to where things were, but that all depends on how deep the recession is and what the liquidity environment looks like next year. So these are the things I'm looking at. I'll see you in the next video.